Good afternoon, everybody, and welcome to today's Ned Group Investment Insights. I'm Trevor Garvin, and I look after Ned Group's multi-manager area. Just a little introduction to investments. We are one of South Africa's leading unit trust companies. We have about 300 billion rand in unit trust funds under management, and we offer a range of both South African rand denominated as well as offshore global US dollar denominated as well as sterling and euros funds, and we offer a range of both single fund manager as well as multi-manager and passive investment solutions. We also have quite a wide range of cash products and enhanced cash products for clients looking for a more capital preservation type of investment product. Now, getting more onto today's topic, I think we all understand and realize that South Africa is at a bit of a crossroads at the moment. We have an economy that has slowed down dramatically, even prior to the COVID-19 crisis, and specifically since the outbreak of the pandemic. And on top of that, our debt burden is ever increasing. So really some tough decisions, I think, that the country and government needs to be facing. So it was really with great interest, I think, that we were all watching yesterday's medium-term budget speech with Minister of Finance Tito Mboweni presenting. And today we have Nicky Weimar, Nedbank's chief economist, who is going to help us unravel it and give some of her comments and insights on it. So, Nicky, welcome to today's presentation, and great to have you here. So Nicky is a regular presenter with Ned Group Investments, and for me, I really enjoy listening to her, particularly because she makes some quite complicated economic concepts and principles really nice and easy to understand. And certainly that's what many of our clients have fed back to us. So we're really looking forward, Nicky, to what you've got to say today. And the agenda, just for everybody that's on the call, is I'm going to hand over to Nicky shortly. She will take us into her presentation. Her presentation is roughly about half an hour, 35 minutes or so in length. And then we will open it up to some questions. I will pose these questions to Nicky and we will obviously get her answers. So we'll have about 15 minutes or so for question and answers after her presentation. So that's really the idea. We hope to be finished within maximum 1 hour. Nicky, so without any further ado, I'd like to hand over to you, and thank you so much for your time today, and we really wait and see what you've got to say, good news or bad news. So I'm handing over to you.
Thank you, Trevor. It's great to be with all of you again today. Looking forward to one day, eventually, ultimately meet in person again. But in the meantime, all of this rigmarole around tech will have to carry us through these unprecedented times. And today we're going to have a look at another fairly, unfortunately, dismal picture. And that is the state of South Africa's finances, government finances that being. So I'm going to take you through the mini budget. We're going to keep it simple. We're going to stick to the basic ideas and concepts that came out of the mini budget. And hopefully, at the end of the day, you'll have enough ammunition to pepper me with questions. So let's start. I think you all know back in June we had the supplementary budget, and Tito Mboweni famously warned us that you are looking really at wide open hippo jaws with essentially government revenue going down and government expenditure rising very rapidly. Part of that rise in expenditure, of course, relates to the fact that government had to increase spending partially to deal with the actual health emergency surrounding COVID-19, and then to deal with the fallout from the lockdown, which in South Africa's case was exceptionally severe. And so a lot of that is the emergency support, the additional UIF funds, the extension to social welfare payments, in order really to carry those really I suppose, the most vulnerable to this crisis through these difficult times. And as such, he indicated that we've got these hippo jaws developing, and you have a situation where really you've got this incredible gap between revenue and expenditure, and you can see that the mini budget doesn't really change the short-term dynamic. You still have this enormous divergence setting in between essentially revenue and expenditure, but the aim is to slowly close it. Now, one of the key criticisms that came out yesterday was that, of course, with every mini budget, they add another year. And if you go back to the June supplementary budget, the aim was to close this divergence in 2022-23, and that's now really been postponed to 2023-24. This is an old budgeting trick. South Africa has been doing that really since the global financial crisis, throughout the Zuma years, constantly postponing the point where you actually have some real fiscal consolidation setting in. Having said that, though, there is nothing really expansionary about this budget. We are not talking about fiscal stimulus here. We are really talking about what has happened to revenue. It is the implosion in revenue that makes the deficit so bad. It is the implosion in tax revenue that really contributes in such a dramatic way to the rise in public debt burden. The spending itself isn't stimulatory. It is really just supportive. It avoids the most dramatic impact. It takes the edge off the pain. It really isn't helping South Africa to grow dramatically faster or moving this economy to a higher growth plane. So let's have a look at what the dynamics and the specifics around some of this is. This is the broad budget framework. In the mini budget, they actually present both the main budget expenditure framework and they present the consolidated framework. The consolidated framework, I think, is a far more accurate indication of what is actually happening out there, because that, of course, includes provincial government and local authorities. And as you can see, it's an exceptionally ugly picture. The budget deficit rises, widens to minus 15.7% of GDP, and then only closes very slowly, minus 10% next year. So we're still sitting with a very big budget going into next year, and then it stays well over the 3% level. In fact, we don't get any sight of 3%. Why does a 3% deficit matter? Because numerous empirical studies have shown that if a country runs budget deficits of over 3% of GDP for an extended period of time, essentially, debt carries interest, and very, very quickly, your borrowings on an annual basis is just so extensive. You have the cumulative effect of interest coming on top of that, and before you know where you are, your debt just accumulates far too rapidly. So countries can run deficits, but they should remain manageable. They should not compromise the future for the present. And if you are going to run bigger deficits than 3% of GDP, ideally the bulk of that deficit should really be used to finance capital expenditure. In other words, infrastructure spending, which of course increases your ability to grow by enhancing your potential growth rate. And if it does that, that means you can grow faster, you can employ more people, and in the process, of course, create more taxpayers. Under those sorts of circumstances, you could perhaps warrant running deficits of over 3% of GDP. The level where we are now, that's just simply dangerous. And you can see that in what happens to our debt. The last column or line there, rather, or row, is your total gross loan debt, and you can see how that jumps dramatically from 63% last year to 81% this year, and then continues to climb. In fact, we'll get back to this this particular issue, which is South Africa's debt burden, a little bit later on. But I suppose the bigger question is just to remind ourselves how on earth we got here. Now, COVID-19 has made everything worse, but as Trevor said, South Africa was in an economic bind prior to COVID-19. We were, in fact, in caught in the middle of probably our longest, well, definitely our longest economic downswing since records began in 1945. Now, according to the Reserve Bank's definition of what defines a downswing, South Africa entered economic downturn in December 2013, and we have really just stayed in that downturn, and that, and circumstances actually worsened. The slump deepened, and in the second half of last year, we re-entered technical recession again, and by the first quarter of this year, it was definitely more than a technical recession. And then came COVID-19, then came that exceptionally strict lockdown, bearing in mind that the bulk of the damage was done in April. In April, we literally were just pushed off a very, very high cliff, and this economy virtually grinded to a halt. And from May, a recovery has started off that low base, but unfortunately, to a large extent, the damage has been done. And it is that which has resulted in revenue falling as a percentage of GDP from 29% last year to only 26.3%. This is substantially worse than what was experienced during the global financial crisis. And it is this implosion in revenue, while you at the same time have an increase in expenditure, that have brought us to the situation where we are. So what is the outcome? What is the sort of assumptions on which this fiscal framework is based? Well, the first thing we knew is that government would probably have to revise their growth estimate for this year in particular. We knew this because GDP contracted on a quarter-on-quarter basis by 51% in the second quarter, and that's annualized, of course. And on a year-on-year basis in the second quarter, we were talking about a decline of about 17%. And for the first half of this year, this economy is now down 8.7%. So in the GDP numbers, your first half really sets the trend for the rest of the year. The third quarter can still have a material impact if we have a strong rebound of the second quarter's exceptionally low base, and let's call it a non-existent base, but it is essentially that first half. So you're going to be in that range of -8% one way or the other. And you can see, I show you here our forecast, I show you National Treasury's latest version of the forecast, which of course is what their revenue estimates are based on for the next 3 years. And then I show you the South African Reserve Bank's latest economic forecast for South Africa. And you can see there for 2020, in the supplementary budget in June, National Treasury worked on an average contraction in GDP of around 7.2%. They've upped that only marginally, or they've scaled it down only marginally to 7.8% contraction, which is still a little bit below the Reserve Bank's, but it's more or less in that range. I should let you know that the IMF, in fact, is very close to the South African Reserve Bank. They expect this economy to contract by -8.1% this year. And then you can see our forecast is substantially worse. There's a couple of reasons for that. We are mainly really taking into consideration a couple of structural issues that we think will re-emerge. One of them being power outages and really a very depleted and diminished and dated electricity system that makes it very difficult for South Africa's recovery to gain momentum. But also built into our forecast is the reality that we don't believe COVID-19 is out of the way. That's very clear from recent developments. You would have heard that yesterday Germany and France have decided to re-enter economy-wide or national lockdown. Now, what does that mean? Well, it means they are going back to what we had in April. Germany has opted for 2 weeks, and then they're going to reassess the health situation. France have chosen an entire month. So that means that for those two countries, you're going to see an implosion in economic activity again in the final quarter of this year. So the global recovery now starting to look quite vulnerable. It was already vulnerable, but it's now starting to look really vulnerable. At the same time, over the last week, the United States reported the highest infection rates they have seen since the pandemic began. So they also perhaps going to head back to a situation where stricter measures of lockdown will be imposed in different states. So the pandemic is still with us. More importantly, from the South African context, we have not seen the return of international tourists. And unfortunately, until this pandemic is out of the way, I don't think we will. And that is now starting to look like it is going to really depress 2020 as well. And as a result of that, we do foresee you'll have a setback in the final quarter, you'll have a relapse in the final quarter of this year, and as a result, we have got a bigger contraction in GDP than the SARB and National Treasury. Then we also have a weaker recovery for very much the same reason. We still believe COVID-19 is going to be an issue, even if a vaccine is in fact miraculously discovered. Not to depress all of you, but at the moment the virus is apparently mutating. The new strains of virus are not the same than the initial outbreak. And it is apparently very difficult to design an effective vaccine for a mutating virus. So there's still so much uncertainty, and this is the reason we have a very modest recovery going forward into 2021. But you can see the Reserve Bank is a little bit more optimistic. They've got 3.9%, and National Treasury is close to them, but actually more conservative than the Reserve Bank. And that's the same situation we have in 2022. So with these sorts of growth numbers, you can see that if you contract by 7.8%, let's use National Treasury's economic forecast, because that's what the revenue estimates are based on, and that's what we're talking about today. And you only grow 3.3 and 1.7%, and their number for 2023 is in fact 1.5%, then you're only getting back to 2019 levels by 2024. And unfortunately, that means your revenue, your tax revenue, your tax collection has taken a big and seemingly quite a long-lasting knock. And that's what we're dealing with here. And if we look at how things are progressing on the tax front at the moment, this is again from the medium-term budget policy statement released yesterday. You can see this is personal income tax collections. It's dropped very sharply for this year. It is starting to recover, but it's still miles off from the levels where it was before the pandemic struck. Situation on VAT looks a little bit more encouraging. There's been a very strong rebound as you saw South Africa move to less strict lockdown levels or alert levels, and people ventured out more. They started buying more goods and services, and as a result, VAT started to bounce back quite nicely. What is quite interesting is there was some buoyancy in August. Nedbank actually puts together on a monthly basis a sort of a collection of our national sales that go through that being just Nedbank's point of sale devices. In other words, that gives us a bit of a sense of the level of economic activity out there. Of course, it only represents Nedbank's market share. It doesn't reflect what is passing through Absa's machines or, F&B, or what's the other one's name? I can't remember. It must be completely insignificant, but in any case, it doesn't tell us what is passing through the other major banks' numbers, but it tells us what is coming through Nedbank in terms of volumes, and it gives you a sense of the level of demand out there. And it's not just August. We know that spending from our numbers suggests renewed buoyancy also coming through in September. So it looks like from the spending side, in any case, the recovery continued with a bit of momentum actually towards the end of the third quarter. So VAT is picking up, but the problem is corporate taxes are not, personal income taxes are not, and they are going to end this year a lot lower. And as a result, government's revenue is going to be under considerable strain. So within the context of that, in order to come up with some kind of recovery in revenue going forward, considering that you have a very modest economic recovery, that you forecasted over the next 3 years, National Treasury has made it clear that there will in fact be tax increases. The exact nature and composition of those taxes are not known to us. I think they will continue to try and avoid increases in VAT. You will probably see the introduction of green taxes in a more aggressive way. You will see also them probably using sugar taxes more aggressively in order to get more money. Excise duties on luxury goods, because that is regressive. It hurts the rich more than it hurts the poor. And yes, they are considering this whole idea of a solidarity levy, which they might use to boost revenue collection in the years going forward. So as a result of that, unfortunately, if you look at what they've planned, they've got tax increases coming through next year, 2021, 2022, and 2023. So they are planning, in fact, for increases in taxes over the next 3 years. Now, I think that it's a bit of a gamble, to be honest with you. If they are going to go for higher wealth taxes, if they are going to go for a kind of solidarity levy, that's fine, but wealth taxes are famously ineffective. You do not raise nearly as much revenue relative to the damage you're doing to the economy than you would through spreading the tax burden wider. In other words, VAT is the most effective option. In South Africa, it's been hugely politicized, but let me just tell you, of all emerging markets, of all African countries, South Africa has the lowest VAT rate. So it isn't actually something that should be politicized, because you do have the power to protect the most vulnerable through zero rating. So unfortunately, I think that you'll probably see the tax system become more complicated. I think you will see it become more inefficient, mainly because they're trying to avoid increasing the most obvious tax that will help them rectify their revenue situation, which is VAT. Right, so that's on the revenue side. Unfortunately, some bad news for South Africans on that front. So what are they going to spend the tax revenue on? Well, unfortunately, this is the reality of running budget deficits of over 3% of GDP consistently since 2009. We haven't had a year where we've had a smaller budget deficit. So as a result, as I said before, you are therefore rapidly entering an unsustainable pattern, and that is where we are now. So debt service cost really eats up, well, it is the fastest growing item of government expenditure, and it is now up to over 22% of government expenditure. It consumes 21 cents of every rand of main budget revenue, which is mainly tax revenue. So debt service cost is the fastest growing item and will remain so over the next 3 years. Then you can see they have prioritized something called economic development and community development. Now this is where President Ramaphosa's reconstruction and recovery plan comes in. And this is really where the infrastructure fund resides, sorry folks, and where they're aiming to spend and reprioritize spending away from consumption expenditure towards really infrastructure spending. This is of course good. This is a good thing. As I said before, if you're going to run deficits, you should really be borrowing to finance capital expenditure, not consumption expenditure like we have done for over a decade. There are all sorts of problems with this. The infrastructure plan raises more questions than it delivers answers. And some of the reasons for that, of course, is that it is very unclear exactly how they're going to finance it. And it's very unclear what the exact scale of it will be. They talk of shovel-ready projects, both in the private sector and in the public sector. But to be honest with you, it is very tricky to discern how many of those are actually shovel-ready, how many have actually started. And to be even more brutally honest, I find it very difficult to imagine that there will be a private company in current circumstances where your economy has just contracted, literally, by 8.7% in the first half of this year, where rapid structural changes are occurring in terms of the way people work, and the way people produce, and the way you have to market, and the way you have to sell, and where there is ample spare capacity, certainly in physical infrastructure, perhaps not in digital infrastructure, but in physical infrastructure. I find it very difficult to imagine that there are companies out there that will actually choose, under these circumstances, to expand capacity even further. So it's, for me, very unlikely that private sector fixed investment will pick up this year, probably not even next year. And if we're going to see a recovery, you first have to see demand pick up. And for us, that is more likely from 2022 onwards. So government and infrastructure spending by government and state-owned enterprises would have to drive this. And the problem with that, of course, is that they have no track record. And they are, unfortunately, a very poor track record in terms of delivering infrastructure on budget and on time. And often by the time that infrastructure is delivered, it had very little of a stimulatory effect because it's so delayed that it's almost outdated by the time it comes on stream, as we have seen with our famous electricity expansion programs in terms of Medupi and Kusile. So there's a lot of answers that still needs to be provided on this front, but in principle, refocusing spending on capital expenditure is something very few people would argue against. So where are they going to cut? They're basically going to focus on cutting back learning and culture, which is of course education. By the way, it is the biggest expenditure item in the budget. So a lot of funds already go to education. There's a lot of waste there, a lot of spending that can be executed in a far more efficient manner. And I think that is the aim there. It's not that government don't value education, they clearly do, but they feel that it has been one of the fastest growing items over the last couple of years as a result of the subsidies for students under the Zuma years, or the Zuma initiative, to provide subsidies to students in response to the fees must fall initiatives that we saw across the country. And the argument is that that's enough now. That money needs to be spent more effectively. So, and then they are wanting to effect big cuts in general public services, of which the biggest item is really compensation of employees. And they're going to try and contain the public sector wage bill to a very, very low real growth of only 0.8% per annum over the next 3 years. So we're not talking about wage constraint for just 1 year. We are talking about wage constraint for 3 years in a row. And then, of course, again, unfortunately, peace and security, where policing, justice, the whole justice system and defense sits, that gets cut even further. And that has not been a priority over the last couple of years in any case. So you see what they're trying to do here. They are trying to do some good stuff. They can't control debt service costs. The only way they can control that is by cutting spending, trying to reduce the deficit, chip away at it, and try at some point in the future to stabilize the debt burden. That's really the only way they can do it. But within that limited space, they are now focusing more on infrastructure spending and less on consumption expenditure, particularly civil service wages and salaries. Now, of course, as you know, this plan has already been taken to court. Public sector unions and the Minister of Finance are due to appear in court in December, I believe it is. And so this plan is still very much, there's a lot that can go wrong with this plan of cutting public sector, the public sector wage bill. Now the question might be, yes, the civil servants probably do have a legal challenge for 2020, or a legal case for 2020, because the Minister of Finance is essentially breaking a 3-year agreement. So he wants to dissolve that early so he can cut civil service pay. But they have much less of a case for the renegotiation over the next 3 years, because really it's not being unfair to them to cut pay. You can get a copy of this presentation. You're all welcome to it. I show you some of the civil service pay grades here. I also show you where they want to cut public sector wages, which departments and where the biggest cuts will come through. And you can see that they have aimed this mainly not at frontline civil servants, not at nurses or doctors or teachers, but really at this enormous bureaucracy that have sprung up over the last decade. And is it unfair? Is National Treasury being really unreasonable to civil service? And the answer is no. You can see here, I show you real wage growth. So we've already adjusted it for the effects of inflation. So this is real growth in public sector wages and in private sector wages. Private sector wages have completely stagnated since 2015, and you can see that it's recently started falling very sharply, reflecting the impact of recession. Look at public sector pay. It's just continued to run away, even after President Ramaphosa took over. So yes, if we're going to share the hardship, if we're going to share the adjustment, the civil servants must also join and make some sacrifices. So the outcome, though, is that you've got this enormous mismatch, falling revenue, you still got spending pressure, you're trying to fix it, you're trying to reorganize it, but the reality is you are running into obstacles all over the place. And the outcome of all of this is that you sit with a higher debt burden. Here you can see, I show you in red there, that was from the supplementary budget, the so-called passive scenario, where Finance Minister Tito Mboweni actually said to us, well, if we do nothing and we just continue on the path of the last decade, this is what happened to our debt burden. It will rise to 140% of GDP by the time we get to 28-29. If we do something, which was the plan back in June, and we actually cut civil service wages, and we actually introduce zero budgeting, and we check every single thing we spend money on, then maybe we can contain the debt burden to a peak of 87% by 23-24 and bring it down to a more reasonable level of around 73% of GDP by 28-26. Now you can see already with a downward revision to GDP, not just for this year, but also for the recovery going forward, that's been the first hit to the debt burden. Okay, so because we look at debt relative to GDP, you now got a much smaller GDP for the next couple of years. Added to that, we'll have a look at it now, you have a very steep yield curve. Added to that, you've got the rand that took a big knock. And as you can see, as a result of it, you sit with the actual projected debt burden now already being higher than they were aiming for in June. The problem is this can't continue, because if we're going to have the national budget next year and we again move up a little bit higher, closer to that red line, because we're again missing the targets, and we get to the October 2021 mini budget, and now we are for the next 3 years on the red line already, but our aim might be to keep it under control. The problem with debt is it accumulates, and that means every year you postpone fiscal consolidation. Every year you postpone making the difficult choices, you push this number further out into the future. So this high debt burden is already going to be a future, the major feature rather, of fiscal policy for the next decade. That's the bottom line. It's what it's going to be. How bad is it in the global context? You might say, but Nicky, for goodness sake, it's COVID-19. Nobody could have foreseen this. And we've had lockdowns the world over. And surely South Africa is not the only emerging market in trouble. And you'd be quite right. In fact, low growth, little inflation, low interest rates, and high debt burdens is probably going to be the legacy of COVID-19 for the next decade. And so, yes, we are not the only emerging market, but the bad news is we are the worst of the lot. So if everyone is bad, you really don't want to stand up. It's like If you're in a group of naughty children, that's fine, as long as you're not the naughtiest child, all right? So you really want to be here in the middle somewhere. But as you can see here, I show you the projected increase in the gross debt to GDP ratio over the next 3 years. And South Africa is going to show the biggest increase of all of these emerging markets that essentially are our peers over the next 3 years. So not just this year, over the next 3 years. So really we're standing out on this front, and that's the problem. Okay, so one of the reasons that the debt trajectory is higher is obviously the downward adjustment to GDP, the fact that the deficit cannot be cut in a hurry, and then of course another big reason given by government is the reality that the yield curve remains quite steep. So this is what the yield curve looks like. Here I show you. So what I show you here in blue, you can see where the yield curve was, ranging from the 3-month money all the way through to your 30 years maturity profile. You can see where it was in blue just before the major risk-off event relating to COVID-19, the big market sell-off, which occurred, of course, in late March. So at that point, the blue line is where the yield curve was. Then the crisis struck. All that was an investor sold everything that had a hint of risk on it. And of course, South Africa came under fire as well. We saw capital outflow from the South African bond market. And as a result, the yield curve shot up to the level where the red line is. So that's the worst spot we hit. And that was during the major market risk event in mid-March, late March this year. Then, as you can see, the Reserve Bank has cut interest rates dramatically. The Reserve Bank responded by cutting interest rates. They responded by buying government debt in order to introduce or smooth out the crisis and restore the normal functioning of the market. And they, of course, also undertook a whole bunch of other things. They eased some of the prudential requirements on banks so that it made it easier for banks, in fact, to support their clients during this difficult time. And what that's done is it's taken us to the green line. So you can see where the green line is now. That is basically yesterday's yield curve, all right? And the lower end or the short end of the curve is now capped by monetary policy, okay? So the interest rate cuts, the repo rate cut, that's dragged down the short end of the curve. And then you still have quite a nice reduction in your yield curve around your 2-year to 5-year level. But the moment you go over 10 years, there's just no interest. There is absolutely no interest in South African debt beyond 10 years. And so as a result, you've got this massive steepening in the yield curve. And this is hurting companies, especially those in the retail industry, especially those in commercial property. So this is really the curve that guides the cost of capital for firms. And this is another reason I don't think fixed investment is going to come roaring back in a hurry, okay? So unfortunately, this is also the reality government faces. So with this year's financing requirement, they've tried to switch out of the longer dated maturities to raising the bulk of their funding through this 2-year and 5-year level, and to the very short end where possible through T-bills. So the reality is they also moving their debt to the shorter duration. So why is there so little interest in South African debt beyond 10 years? Well, that's where the fiscal risk comes into the equation. So the first point I have to make here is this is not unique to South Africa. This is in fact an emerging market phenomenon. I look regularly at the International Institute of Finance capital flow figures. They have an excellent database where they track portfolio flows both into sovereign debt and into equities across the globe per country, and then they group it together. And the IIF numbers as of yesterday shows that really there has been no net return to emerging markets, even though you have a universe of almost 17 trillion rand of negative yielding bonds, high-grade bonds at the moment. You've got US interest rates near zero, with the Fed giving clear guidance that it's probably going to stay that way until 2023. You've got the Bank of England considering going to negative interest rates. You've got the ECB already in negative interest rate territory, and you've got the Bank of Japan already in negative interest rate territory. You've got vast amounts of money being printed. The printing presses are working overtime as we speak. The US balance sheet, Federal Reserve's balance sheet, now amounts to 30% of their GDP. The ECB, which people don't often mention, but the ECB is actually worse than the US Fed. The ECB's balance sheet is now 50% of Eurozone GDP. That's how aggressively they are providing the system with liquidity. And with Germany and France going back into lockdown, you're probably going to have to see the ECB do even more work in the months ahead to keep that economy afloat. So in that environment, you would have expected that even though most emerging markets have cut their interest rates, including South Africa, we still offer on the longer end very attractive yields to investors. And yet they haven't taken up this opportunity. Why? Well, there is the argument that emerging markets are in a situation where their debt is becoming unsustainable, and there is particularly no interest in local currency denominated sovereign debt. And the fear here is that for many emerging markets like South Africa, when the day comes when governments can no longer finance their funding gaps or their funding requirements, they're going to force central banks to do that. So that whole idea of fiscal dominance, that is very prominent, and it is weighing on investors out there, and that is especially affecting local currency denominated sovereign debt. And it is for this reason also that National Treasury states in the mini budget they want to issue more foreign currency debt. But here's the problem: foreign currency debt isn't always a good idea, because you need to be in that market. And yes, you might get foreigners more willing to take that up because they eliminate at least the currency element to it, or the currency risk attached to it. But the reality is that for you as a sovereign, that exposes you to a huge amount of risk, interest rate risk, currency risk, and therefore potentially significant financing issues going forward. But in any case, this is probably the reason you are seeing the situation in South Africa where there's just no interest in local currency debt at the moment, and you are seeing that in fact across the emerging market universe. And we can see that foreign purchases to South Africa, and especially into bonds, it's stabilized, but it hasn't started to recover. And you can also see that risk premiums remain high for really all emerging markets. It's elevated from last year. And South Africa at this point is considered more risky than Brazil and more risky than Russia. Luckily for us, we still have got Turkey and Argentina, which have literally written the rule book of what on earth not to do in the middle of a crisis, all right? So we could just use them as counter indications. So it would take a feat of incredible incompetence for us to wind up where Turkey and Argentina is. So at this point, we're not there, but you are dealing with these high risk premiums, and that's really being priced in to the yield curve, and that's contributing to our debt situation. So it's an ugly picture, and it's going to stay an ugly picture, and it's going to be the dominant concern for the next decade as far as fiscal policy is concerned. So what's clear from this? Government cannot stimulate this economy. That's the one thing that's clear. And we should really just accept that. The only thing government can do effectively is create an enabling environment. And that means structural reforms can no longer be postponed. Okay, government has literally run out of road to kick that can down, and they're going to have to start tackling some of these things. Now, to be honest with you, the Reconstruction and Recovery Plan, it's got good elements. The deregulation of the energy and transport markets, the licensing of spectrum, the greater urgency that's been placed on that. All of those things are good things. It will put us in a better position. But what the Reconstruction and Recovery Plan is very thin on are the uncertainties that are really keeping foreign capital away from South Africa. We need certainty on private property rights. We need certainty on some of the long-standing issues in the mining industry, like the mining charter, like the resources and minerals amendment bill, like immigration, and especially immigration legislation around the import of skilled labor. All of these things have not been dealt with at all. Never mind labor legislation, which is probably one of the major contributors to the fact that we still sit with a very high unemployment rate. So these are the things that government can address. It's cheap to do. It's not going to cost them a fortune. A lot of work has already been done about what would be the better fit by the IMF, by the World Bank, by the CDE, by government itself. It's now really just about taking that action. And even if they do, it will take time. So the bottom line here is government will have to be disciplined. Thanks. That's it.
Great. Thanks a lot, Nicky, for that. Very interesting, as always. I mean, just one of the things that definitely pops into my head, which is quite interesting, is the whole concept of compounding. So we often have equity managers presenting to us, and what they really are looking for is, you know, positive cash flows with stocks, and how positive cash flows lead to a positive compounding effect, which is positive for equities. And it's exactly that really compounding effect that has positive effect on equities that is exactly the negative effect if it's debt, and your debt burden is of course growing, and you just have this negative spiral from compounding. Nicky, we'll take a few questions. I have been writing them down and watching them as they're popping up on the screen. So some of them probably are quicker answers and some of them are a little bit more not so quick. I'm going to start off with a medium one, and then we'll maybe tackle a few quick ones, and then we'll get to a few other ones. So I think a point that you made in your final slide, and which one of the questions touches on, is just the determination of government and Treasury. And can one really trust what they're saying? So, you know, generally, if we look back over the last couple of budgets, they've tended to be overly optimistic in terms of their tax collection forecasts, the debt amount not growing at particular rates, etc. And it's generally been on the overshooting and rather than undershooting. So how can we? Are we confident in these sort of forecasts? And you showed the lower road, the upper road, and the medium road just now. But how much faith do you have in their forecasts that they've put out in this medium-term budget and actually being able to attain them?
Okay, so on the economic forecast, I'll forgive them for any mistakes they might make, as I hope others will forgive me for any mistakes I may make under the current circumstances, to be honest with you, Trevor. So I think they're not wildly out of line. They're not wildly out of line with what we are saying. They're not wildly out of line with what the IMF is saying, what the Reserve Bank is saying. And in the case of the Reserve Bank, I'm not sure about Treasury's model, but I know the Reserve Bank has a very robust model that they use to do their forecast. And even so, the Reserve Bank has proved to be too optimistic, more often than being too negative. So in the end, that seems to be where they've been wrong, is on the upside rather than on the downside. So the reality is, on the economic forecast, that looks reasonable to me. Yes. As for the rest, it's absolutely true. There is good reason to doubt whether they will be able to stick to those expenditure objectives. It's equally there's equally good reason to doubt whether they will actually meet these kind of revenue projections, because it's not just a function of raising taxes. You also have to collect them. And we know that SARS is trying to rebuild, but they have enormous vacancies. They're struggling to process all the data. It's a race against time. You know, so a lot of questions around the efficiency of tax collection as well on that front. So yes, I would certainly say there's a very strong probability that at the end of the day, our debt trajectory is actually somewhere between the yellow line, where they're estimating it now, and that red line.
Yeah.
I think there's a good chance that they're going to struggle to meet these targets.
Okay, so just thanks for that, Nicky. So I'm going to just shoot a few questions at you, which if we can try and keep the answers short-ish. Sure. But I think there are ones on people's minds, and then we can tackle a few others. So the one key thing that you actually didn't really mention directly in the talk is the lovely SAA, and we know they allocated 10.5 billion yesterday to SAA, which Tito was very careful to say it's a rescue package and not a bailout, I think were his words or something. But the question just to you with a short answer is, why is SAA so precious to the government to keep going?
No, I have no idea. I have no idea. There's the short answer on that one. It really does not make sense. And in many ways, you are actually prioritizing SAA jobs over jobs elsewhere, and over other spending priorities, which really just doesn't make sense. There are also portions of SAA that can be sold off profitably, you know, and might have a chance of survival if they were more open to the notion of privatization.
Yep. So that's then perhaps my next question you touched on as well is, I think jobs can really be created in two key parts of the economy, or by, you know, either government creating jobs through their infrastructure programs, etc., or of course the private sector, private business, listed companies creating jobs as well, as long as that environment is economically friendly, I guess, and you did make that point. Do you think that the government has got this balance between creating jobs through their own stimulus programs, infrastructure programs, etc., versus creating the right atmosphere for private business to create jobs? Have they got that balance and mix right, or should they be doing more in the private sector?
Yeah, I think they're still not in the right headspace. I would call it a headspace. They still, and it's something that's developed through the Zuma years, you know. There was always this thing, we're going to make a big announcement and we're going to lead this country, this notion of a developmental state, and that the state actually drives economic growth and drives job creation. And if anything, if the past 10 years proved anything, it's exactly how unbelievably wrong that assumption was, all right? Because it did the complete opposite. All right, so on every single metric, the outcome has been worse, on unemployment, on inequality, on essentially job creation, on economic growth. It doesn't matter where you look, on general infrastructure. It just not delivered it. Okay, so I don't think they've quite broken the spell or the power of this notion of a developmental state. And there's also a trust issue. They still don't quite trust the private sector to actually create jobs and to actually move this economy forward.
Yes. Yeah, no, it's a tough battle. I mean, I know, you know, I mean, Nedbank and Mike Brown's been very closely involved with this, you know, the group of private businesses, heads of listed companies working with government. Nicky, can you just give a question was, can you give a brief just explanation of what exactly is a solidarity levy tax?
You know, I don't know if you recall, I might be much older than most of the people listening, so I'm going to check, Trevor. I might even be older than you. And if I wasn't older at the beginning of this year, I definitely am by the end of this year. So you remember when we just switched over in the days of GEAR, when we still had GEAR, the RDP, when South Africa just became a democracy, they imposed a short-term levy on, and we inherited a very, very messy apartheid government infrastructure. We were at that point still excluded from the global financial markets. We sat with a mountain of debt and a very big deficit. They introduced almost like a transition levy on pension funds. Do you remember that?
Yes.
It could take that shape again.
Okay.
Yeah.
Yeah, and would you see that coming in the February budget next year?
I think so. They don't have time to waste, and they're desperate for revenue. So yes.
Nicky, just slightly differing question. You did mention, and we saw it announced yesterday, as you said, with Germany going back into lockdown. The UK, we know, has done a little bit differently, where they're doing it in different counties and things like that. We have seen an uptick in South Africa in number of cases, varies a bit from city to city, province to province. And we know, of course, where we've come from in terms of the lockdown levels. If we do see a surge, luckily we are going into summer and warmer weather, but is it realistic even for South Africa and the government to start moving back up the lockdown level, just given the crippling effects that it has on the economy, on businesses, and just everything that we're really talking about today? Where do you see them balancing again the economy versus managing the pandemic?
Yeah, I really think that if the second quarter proves anything, is that we can't do this again. We can't do a level 5 again and survive. Then you are talking about permanent damage. You are talking about some companies that will definitely fold. Then we'll see bankruptcies rise very dramatically. The 2.2 million jobs lost in the second quarter will look like a picnic compared to what lies ahead. So they're going to have to strike a balance, and they're going to have to stress that point. And I think it's also very, very important that each of us as individuals realize, especially the younger generation, because they've become the super spreaders in Europe, that they are mainly to blame for how the actual pandemic started there. And in the US, as you know, it's Donald Trump, but he's not exactly human. We're not certain he's from Earth. He doesn't quite look like he meets the standards. But in Europe, it's been the younger generation. In the UK, it's been the younger generation. And I think that it's very important that people realize that as much as it is government's responsibility to look after the most vulnerable in society, we are not children, and we actually have to collectively behave to get rid of COVID-19. And what you've seen, and Johns Hopkins University has done a lot of research on this, countries with high levels of compliance are countries that have managed to keep COVID, firstly, to bring it under control quickly, and secondly, to eradicate it. Taiwan is a perfect example. They're now at 200 days, unbelievable. China's another example. South Korea is another example. So ultimately, it's each and every individual that has to behave in a socially responsible way. And unless we have that, you force government's hand in a way. You put them in a very difficult situation.
Yes, agreed. So let's see how it goes. And as you said, I think we've got to all keep our children at bay, specifically for people who are writing matric. It seems like if you get COVID and you're in matric, You can only write it towards the middle and end of next year again. Nicky, just talking on interest rates quickly, a question was just on, let's call it the next 12 months. Do you anticipate interest rates changing, whether it be downwards or upwards, or do you just see it being held flat at the moment?
Okay, so the Reserve Bank at this point, they produce, as you'll know, at every monetary policy committee meeting, they produce their quarterly forecast for the repo rate. And this is called their quarterly projection model. And it is currently suggesting that rates remain unchanged for the rest of this year, and then that you have a 25 basis point hike in the third quarter and another 25 basis point hike in the final quarter of next year in order to keep inflation around that sort of 4.5% midpoint of the Reserve Bank's inflation targeting range. Our forecast is rates remains unchanged. If we go back into stricter levels of lockdown, I think the possibility of interest rate cuts being put back on the table is very high. Okay, because of course growth is going to implode, and then inflation is a non-issue. Then it's really just about getting some demand and reviving some demand. But for now, we say unchanged until the end of 2020. We do not believe there's going to be scope for hiking rates.
Great, thank you. Nicky, I think just two more questions and then we'll need to end off because we are just coming up for that 1 hour. I'll leave the one till the end, our closing one. I'll just start off with my second last one then. So the a question just was actually, and it's a bit more perhaps Nedbank specific, but it does talk perhaps to the other banks and the lending industry. From a Nedbank perspective, would you see the banks in terms of whether it be retail, corporate, commercial on lending, that they're going to be putting more stringent measures in place to manage their lending book, given relatively the risks in the whole economic outlook, in order to just watch that the bad debt potential book, I guess, moving into the future? So just, is lending going to become more stringent in the current economic climate?
You know, I think the best answer to that, and I have been actually quite deeply involved in that process, is that there is a whole sort of governance process around risk management in the banking sector. And then there is the supervision of the South African Reserve Bank as well. And the South African Reserve Bank have often indicated that they watch developments within the individual banks very closely. And so the best way to answer that is, if we see a surge in bad debts, or we believe and anticipate that it is likely to follow, banks will obviously have to make the provisions for that. And at the same time, they will also obviously have to maybe revisit some of their lending standards. But I can tell you that I know for certain that lending standards are already very strict in South Africa. They're very thorough. So at this point, I think the banks have a strong handle on the situation as it is unfolding.
Great, thanks for that. So just to end off then, Nicky, first of all, thank you for your time, and I'll leave you with the opportunity to maybe leave some hope with us, or maybe not. So, and this is, you know, one of the things I think on my mind is, I mean, even just yesterday, Tito in the speech was saying he's expecting 3% or so growth next year, coming off this low base from now. And then I think he was talking about 1.5 and 1, or the other way around, something like that. Now we know if we go back to the Thabo Mbeki days, we were having growth anywhere between 3 to 5% for a 5-year period, perhaps, and the economy was booming. Given that even the government is saying they're only expecting on average 1 to 2% economic growth, I mean, we know that that's not really enough to really get unemployment out of the way, to get the economy booming. We know that there's problems with education. We've spoken about, you've presented the debt crisis and the key of managing that. So if we actually just have to look on a longer term basis, with 5-10 year view, how do you really just see the economy going? How do you see the government getting us through the next tough patch, and can we really look forward to a longer term rosier picture?
Yes, I think so. I mean, I think, to be fair, this has been, exceptionally difficult year, a 1 in 100 year event, a risk event has struck the world, and it struck South Africa. And yes, because we were vulnerable to begin with, the impact on us has been that much more dramatic. But I think going forward, we will eventually return to some form of growth. It will take time to get back to the levels where we were. I still feel that under President Ramaphosa, there are some positive developments that are being implemented. And I think the biggest one of those that I think can have an enormous impact on confidence in South Africa is the emphasis he's placed on fighting corruption, and specifically the introduction of an open tender system. It is a lot harder to cheat if the whole process is incredibly transparent. So I think that is an encouraging development, and if they can put that in place quickly, I think you might see, in fact, that spending will come down quite significantly in the years to come.
Nicky, thank you so much. We've run out of time. We could keep on going, I know, for ages. We're already like an hour and 10 minutes or so. That's been extremely interesting as always. Thank you so much for always coming and talking to us and our clients. We really, really appreciate it. And I'm sure and know you will be back sometime. So keep up the good work. Just to everybody on the line, just to end off with two things. First of all, to invite everybody to register and join us on next week, Tuesday, the 3rd of November at 10 o'clock in the morning is the next Ned Group Investments session, where we have our 2 property managers presenting, our domestic property manager, Ian Anderson, as well as our global property manager from Resolution Capital, and they will be debating the pros and cons of property, local property versus global property. So it should prove to be extremely interesting and insightful. And then also just to remind everybody of our monthly output that we do. It's a new report. We've been doing it for about 3-4 months now, called the Ned Group Investments Pulse Report. It contains really, really interesting information, monthly information on unit trust performance figures, global markets, local markets, currencies, interesting insights, and it's been extremely popular. And for those of you who haven't registered to get it, I encourage you to go to the Ned Group website and register to get it. The next one will be coming out on around about the 10th of November or so. So with that, I would like to thank everybody for joining in. We had close to 500, I think, people dialed in today, so that's amazing. Wishing you all a good rest of the week, amazing weekend, and hopefully see you next week for the property presentation. Thanks, everybody.